Below market value property, it's one of the most talked about strategies in property. Everyone wants to find these type of deals and everyone wants to create equity on day one. But here's the reality, okay? Most people never actually execute on them. And it's not because they can't find these deals, it's because they don't understand how to fund them properly. And in this space, it's not about who sees the opportunity first, it's about who's actually in a position to act when it shows up. So in this video, I'm going to break it down properly for you, what below market value actually is, where these deals come from, and how they're funded in the real world. And more importantly, how you put yourself in a position to actually take advantage of them. Let's start with the basics, but from the right angle, okay? So below market value, or BMV, is when you acquire a property for less than its true open market value. So not what it's listed for, not what the seller hopes it's worth, what a professional valuation would support today. So let's say a property is genuinely worth £200,000 and you agree a purchase at £150,000. That £50,000 difference, that's not just a good deal, that's built in equity from day one. And that equity is what gives you leverage, okay? Because instead of waiting for years for appreciation, you've effectively created that in the moment you've completed that transaction. Now, here's the important shift. This isn't about buying cheap property, it's about understanding why the opportunity exists in the first place. Because good deals don't just sit there waiting for you, they come from situations. Once you understand the pattern, you start to see them everywhere, okay? Typically, you're looking at sellers who need speed over price, probate or inherited properties, landlords exiting portfolios quickly, properties that may need a refurbishment, auction deals with tight deadlines, off-market opportunities through relationships. The common thread is always the same. The seller isn't chasing maximum value, they're chasing certainty, and they want the deal done quickly, cleanly, and without risk, okay? And that's where you step in, because if you can provide that certainty to a seller, you can negotiate on that particular price for that asset. And that's the trade, okay? Speed and execution in exchange for equity. Now, this is where most people fall down. They find what looks to be a great opportunity, and then they try to fund it the exact same way they would do with a standard purchase through a traditional mortgage. And that's where the problem starts, because mortgages are built for, let's say, stability, low risk, time, and you're talking anywhere from 6 to 8 weeks to complete on such a transaction. Strict criteria, properties needing to be mortgageable from day one, but below market value deals, they don't just wait around. You might only have 14, 21 or 28 days if you're lucky to complete. And if you can't move in that window, you simply lose the deal. It's as simple as that. So it's not that people don't find the opportunities, they just can't execute when it matters. So this is where your mindset has to change. Instead of asking, can I get a mortgage? You need to ask, what's the right funding structure for this particular deal? And in most genuine below market value situations, that's bridging finance. Now, bridging gets a bad reputation because people focus purely on cost, but that's the missing point completely in this situation. Bridging, okay, is designed for, let's say, speed, flexibility, short-term execution. And essentially, it allows you to move at a pace that particular deal requires. And more importantly, it allows lenders to assess the deal differently. And this is where it becomes really powerful, because not all funding is equal and not all brokers have access to the same level of lending. For genuine below market value deals, I've got access to funding that can go up to 100% of the open market value, not the purchase price, the actual open market value. So let's break that down properly. If a property is worth £200,000 and you secure it at £150,000, I can potentially structure funding based on that value of £200,000, which means to you, your full purchase could be covered, you're only bringing in costs, and in some cases, very little cash is left in the deal. And that's how serious investors are scaling, is what I'm seeing in the marketplace. They're not tying all of their capital into one deal. They're using the strength of the deal itself to fund the acquisition. Now, on top of that, I've also got access to preferential rates through established lender relationships. So not only are we structuring deals at a higher level, we're doing it efficiently as well. And this is the key, okay? This only works with genuine below market value deals. The valuation has to stack, the rationale has to make sense, and the exit has to be clear. This isn't about stretching numbers, okay? It's about structuring strong deals properly. Let me give you a couple of real world style scenarios. So example one, let's say you acquire a property at £180,000 that's genuinely worth £250,000 due to the seller needing a fast exit. I structure funding against the value of £250,000. You complete quickly, carry out light improvements and refinance at a higher valuation. You've now created equity, okay, without tying up large amounts of capital. Example 2, let's say you secure a small portfolio, say 3 units for £600,000, but the true combined value is closer to £750,000. Because you can move quickly and fund it correctly, okay, you secure the deal in one go. Now, instead of buying one property, you've added 3 assets with built-in equity from day one. That's how portfolios accelerate. So when you zoom out, the model is actually quite simple. So step 1, acquire below market value. Step 2, use the right funding, typically bridging to move quickly, okay? Step 3, improve, stabilize or reposition the asset. Step 4, refinance or sell. If it's structured properly, okay, you recycle your capital and go again. That's the difference between buying property and building portfolios.
Now let's address the obvious question, cost. Yes, bridging is more expensive than traditional lending, but you're not paying for long-term finance here. You're paying for speed, you're paying for access, and you're paying for the ability to execute on a particular deal. Because the real cost isn't in the interest rate, it's in missing that deal in particular. If there's 50,000, 100,000 or 150,000 of upside in a particular deal, the cost of the finance becomes part of the strategy, not the obstacle.
But let's keep this grounded, okay? Not every below market value deal is a good one. You still need to assess, why is it discounted? What work is required? Whether the valuation is realistic? What your exit strategy is? Because the funding only works, okay, when the deal works itself. No structure can fix a bad deal. So when you're looking at below market value opportunities, don't just focus on the price, focus on speed, structure, funding, because the investors who win in this space, okay, aren't just good at finding deals, they're in a position to act on them and act on them really, really fast. And that's where everything changes.